Alrighty, let's take a look at exercise 10-6. So the architect company had the following additional information at November 30th, 2020, which was its year end. Unearned revenue account showed a balance of $62,000, which represented 4 months of services paid in advance by a client for services beginning on October 15th, 2020. The payroll register showed the following amounts unpaid as of November 30th, 2020. Sorry, I have a headset on and trying to fix it. Squishing my glasses. Here we go. So these amounts here, and then the November utility bill in the amount of $21.60 was unpaid and unrecorded at November 30th. Prepare the appropriate entries at year end based on the above information. Okay, so we go back to A. So unearned revenue had a balance of $62,000, which represented 4 months of services paid in advance, but the services began in October 15th. So that means as of November 30th, the rest of October, so half a month, and all of November had been performed. So that means we need to take those out of unearned revenue and move them into service revenue, or act like the actual revenue. All right, so $62,000 was for 4 months, so divided by 4 is $15,500 per month. And as we said, we have the rest of October, so half of October and all of November, which was a month and a half. So it's about $23,250. So we debit unearned revenue because it would have been sitting there as a credit. So we debit $23,250 to take it out of unearned revenue, and then we credit service revenue. B, the payroll registered showed the following unpaid amounts as of November 30th. So we have to do an entry to record the payroll. So they have it broken out here, office salaries and sales salaries. So office salaries expense, sales salaries expense, that's the full amount, $2,500 and $1,800, so we debit. Then we go back and, so the EI to be paid, so EI payable is $80.41. Income taxes payable, $1,290. CPP payable, $183.98. So this total deductions just totals up these three, and then the net payable. So our gross less our total deductions, which are these three here totaled into this. The gross less the total deductions equals the net amount payable. So that goes in salaries payable, $27.45.61. So here we're accruing the payroll amounts that are to be paid. So we're recognizing the expense this period, and then we're putting in a payable to be paid after year end. Then they also indicate here employers have to pay CPP and EI, the employer portion. So EI is 1.4 times the amount that the employee pays, and CPP is the same. So we go to EI, it was $80.41. So the employer's portion is $80.41 times 1.4, which is $112.57. CPP is going to be the same. So CPP here for the employee was $183.98. So the employer records the expense because the work happened this period, so we record the expense, and then we record the payable. It's going to be paid after year end. And C, the November utility bill in the amount of $2,160 was unpaid and unrecorded at year end. So now we're going to record that utility bill, so utility expense, and it's to be paid later, so it's accounts payable. So again, we're recording these expenses because it's the matching principle. The work happened, the utility bill was, like I said, the services were performed, we use the electricity, whatever, in the current period, so we record the expense there and we accrue the payable.